The FASB and ISB recently issued its final revenue recognition standard. This standard replaces substantially all revenue guidance in U.S. GAAP, including the industry-specific and transaction-specific guidance. The standard affects a lot of different industries, but today on our podcast we're going to be talking specifically about consumer products companies. My name is Brian Schilb, and with me today I have Dan Amat. The core principle of the revenue standard is that an entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. And to achieve that core principle, the standard establishes a 5-step model. First, identify the contract with the customer. Step 2, identify the performance obligations in the contract. Step 3, determine the transaction price. Step 4, allocate the transaction price to the performance obligations. And Step 5, recognize revenue when or as a performance obligation is satisfied. So Dan, let's talk about how the new standard will impact consumer products companies.
Thanks, Brian. There are a few key areas we think that consumer products companies could be impacted by the new standard. We'll highlight a few of them here today. And the first one we'll talk about is the identification of performance obligations. So we're in Step 2. It's a common practice for companies in consumer products to offer various sales incentives to their customers or to an end consumer if they sell through a reseller. And this could be in the form of various goods or services. So under current U.S. GAAP, these incentives are typically scoped out from our current multi-deliverable requirements if they're non-substantial, and they're recognized as expenses. So the potential change here is that under the new standard, a performance obligation may arise when that good or service is promised, that incentive is promised either explicitly or implicitly at the time that the parties enter into the contract. Because the transaction price must be allocated to each performance obligation, you could be in a situation where revenue gets deferred if the timing of the transfer is different. So if the timing of the transfer of the underlying good and the incentive is different, you could end up with revenue getting deferred on the latter item. Takeaway here is that in the new standard, no materiality scope out within the standard itself, but preparers will need to assess the overall materiality to their financial statements in determining whether they want to have a non-GAAP policy to expense and not allocate revenue to a sales incentive. Going back to the idea of timing of a transfer, when we talk about timing of a transfer, remember revenue is recognized for each performance obligation as that performance obligation is transferred to the customer. Now, the new standard includes indicators of transfer of control rather than criteria that must be met under current guidance. So there is a potential there that there could be some differences in the timing of revenue recognition.
So going back to sales incentives, if I don't sell that product that I'm giving as a sales incentive, if I don't sell it separately, how would I allocate revenue to that incentive?
Yeah, that's a good question, and I think it's a situation that many companies will find themselves in. And so that gets us into Step 4 of the standard. Obviously, an observable market price is most preferable, but in the absence of that, management will be required to estimate a standalone selling price. The guidance within Step 4 gives some options to estimate that. There's an adjusted market approach, there's an expected cost plus margin approach, and then lastly, if neither of those are feasible, you have a residual approach. So there's a list of factors to consider in making that estimate, but there is no out. If you don't sell that product separately, you have to look at all key factors and make an estimate for that sales incentive. So that leads us to the next topic, considerations payable to a customer. Another common practice in consumer products, so this could be a rebate, payment for ad support, or slotting fees. And so under current U.S. GAAP, these cash payments made to a customer are presumed to be a reduction to revenue. And you can overcome this presumption if you can identify a clear benefit for that payment and the fair value of that benefit can be reasonably estimated. Under the new standard, the presumption goes away. A company still must determine whether it is receiving a distinct good or service in exchange for that payment. And if not, then the payment will still be a reduction to transaction price. So it's a little different path to get there, but you may end up in the same place, which is at reduction of revenue. And then slotting fees, I mentioned, this is one type of consideration paid. Under current practice, generally a reduction to revenue because there is no identifiable benefit. I'll say that for the new standard, it's not yet clear to what extent, if at all, the accounting for slotting fees will change. That's kind of yet to be seen, and it's really facts and circumstances driven. It gets back to, are you receiving a distinct good or service in exchange for that payment? So the next topic we'll cover is warranties. Under current U.S. GAAP, product warranties are typically accounted for as a cost. We're in the FAS 5 territory. No impact on revenue, unless a company is providing a warranty that's a separately priced arrangement. And if that's the case, then revenue is recognized for that separately priced warranty through the contract period. Under the new standard, an assurance type warranty, so just think of your basic warranty, the product will function as promised for a certain period of time, still under cost accrual accounting, no change there. But if your warranty is providing the customer with an extra service or a longer than usual coverage period, that will likely be a separate performance obligation, even if it's not separately priced in a contract. Revenue will need to be allocated in that situation, and you will need to figure out a separate standalone price. And in many cases, if there is a contract amount on that additional warranty or on a specific task, think of oil changes and tire rotations in the idea of a car sale, there may be a contract price on those things, but the standalone selling price may differ. So you can't just go to the contract amount. You really need to figure out what's the standalone selling price.
How should a company assess whether a warranty is assurance or service when it's not sold separately from the underlying product?
Yeah, so there will be some situations where it's not very clear whether you're in assurance warranty territory or whether you're providing an additional service or warranty that there should be a separate performance obligation. So the standard does give some factors to consider in making that assessment. So a couple things: is the warranty required by law? How long is the warranty period? Typically, the longer you go, you're getting outside the range of just protecting the customer from a defective product. Another point to consider is, what is the nature of the tasks that you're promising to perform? So if you're providing some maintenance services in addition to an assurance warranty, clearly that's outside of just guaranteeing the customer that the product won't be defective. So the next thing on this slide is rights of return. Couple points on rights of return. Under current GAAP, revenue can only be recognized on a product with a right of return if certain criteria are met. That includes making a reasonable estimate of future returns. Under the new standard, that criteria goes away, and companies will be required to estimate returns and recognize revenue to the extent that it's probable that you won't have a significant reversal at the end of the right of return period. So we refer to that in the standard as a constraint on variable consideration. One other point on rights of return: balance sheet presentation. You are required to present your refund liability and your right of return asset, so the underlying cost of products you expect to be returned, on a gross basis. So you'll have a right of return asset and a refund liability. Last topic I'll cover for consumer products companies: sales to a distributor. So very common to sell through to your end customer through a distributor network or through a reseller. So in this case, under the new standard, there is no more sell-through election as is currently provided in U.S. GAAP. Rather, companies will be required to estimate the amount of consideration they expect to be entitled to, and then applying, again, that idea of constraint on variable consideration when they transfer control of the product to the distributor or the reseller.
The effective date of the new standard for public business entities and certain not-for-profits is fiscal years and interim periods within those years beginning after 12/15 of 2016. So if you're a calendar year-end public company, adopt the standard on January 1st of 2017. And then for all other entities, there's a one-year deferral. There will be some significant new disclosures required. An entity has a couple of different choices here with respect to transition. First of all, an entity could elect to adopt the standard retrospectively. And as part of the retrospective application, an entity could elect some practical expedients to make that somewhat easier. An entity could also choose to elect the standard using the cumulative effect at the date of adoption. And if you elect this option, the entity would adopt the standard on 1/1/17, and the two comparative periods, 2015 and 2016, would not be restated in the financial statements. But for those contracts that are not closed yet as of 1/1/17, you'd have to apply the standard retrospectively to those contracts with the change shown in the beginning retained earnings as of 1/1/17. So I'd like to thank Dan, and I'd like to thank our listeners today. For additional information, please refer to KPMG's Financial Reporting Network, including the latest on the revenue recognition page, which links to KPMG analysis of the new standard, including defining issues, webcasts, and other podcasts.